This second part of a special presentation on retail brokers. In the last video, we looked at stop hunting and how this is not retail brokers. It does occur, but it's not retail brokers. It's actually larger funds and banks and big players basically trying to get liquidity for themselves. So the next thing we're going to look at in this video is the intraday volatility and changing market conditions, because this is what moves the market. This is what whips the price up and down. And this is why if you're using small stops, you're going to get pretty much stopped out every time, because there's so many things coming through the news feeds and different traders reacting to different things. The price is so volatile, you're almost certainly going to get whipped out. Okay, and this is a look at how this works and how traders react to this kind of information. So the first thing we're going to look at is well, I've basically brought up an example of this is a headline from the news feed. Okay, and this illustrates exactly how these headlines are watched by the market and are definitely moving the markets. And the most important point about all this is that they're completely unpredictable. Okay, you never know what headline's going to come through next. There's no point placing a trade. If your technical indicator tells you to buy, that's all very well, but then 5 minutes later, if a headline comes through which is going to cause the currency to weaken, there's nothing that's going to stop that. The currency will go down. You will get stopped out of your trade. So it's imperative to be watching these headlines so you're tuned in to what the market's tuned into, and you're reacting to the same thing that the market's reacting to. Okay. Now, this headline we've got here is talking about commodity-linked currencies, okay? So in the session, or the very beginning of the session, pretty much an hour after the session opened, we were looking at weakness in commodity-linked currencies. Now, one of the currencies that we were looking at, if you look at the bottom headline here, is Canadian dollar weakness linked to pre-positioning ahead of next week's Bank of Canada decision, with expectations growing for the bank to turn more dovish. Now, this is a rumor that's been, gaining ahead of steam on the feeds. Lots of traders are starting to think that the Bank of Canada are going to become dovish, and with this expectation, the markets are going to trade that. Okay, so therefore they're going to sell Canadian dollar, which means buy a pair like dollar CAD. Okay, so you're buying the dollar, you're selling the Canadian dollar. Okay, so this is the expectation going in. Note it was posted just before 9 a.m. London time. Okay, and if we go to the charts, we can see this is a kind of time here. You can see around about 9 a.m. Canadian dollar had been selling off through the night. Okay, been going up through the night off the back of that rumor. And once that headline came out, more and more of the market participants started reacting to it. It really gave the market another injection, another reason to start selling Canadian dollar, and you can see the price moved up. Now, not only does this give us great trading opportunities, if we keep our eye on the feed, we can make nice, easy pips by kind of basically seeing what the rest of the market's going to react to. But the key here is if you're a frustrated trader and you keep getting stopped out, it's probably because you're not paying any attention to the news feeds, you're not paying any attention to what's going on, you're not paying any attention to what the rest of the market is watching so closely. Therefore, how can you ever expect to get any kind of consistency and make any kind of profits? It's going to constantly feel like you're getting into the market, you get stopped out. You take another trade, you get stopped out. Because if you're basing it purely off a technical indicator, just looking at a chart, you've got no idea what's moving the market. So your signal might give you a sell signal, but then something really positive might happen and the price is going to go up. Every time the fundamentals will win. Okay. Now, sometimes if the market's in a long established trend, technicals will work great because the price is only ever moving in one direction day after day, which does happen from time to time. But if you've been trading for any length of time, you'll know that this happens very, very infrequently and certainly not enough to make any kind of consistent profit. Okay. So the second key to avoiding the frustration of getting whipped out of your trade, stopped, kind of pushed around by the price, is to start trading in line with the rest of the market. And to do that, you need to follow the feed. And it's not just about economic events on the calendar. It's not just about, CPI or GDP figures, what economic release is coming out today or tomorrow. It's about what exactly is happening in the markets. And most importantly, what the market is focused on. And the news feeds with the research reports and analysis will give you all of that information so that you are most of the time on the right side of the move. Now, it could well be that you're trading that and then something else happens to change the sentiment, which is fine because, you're going to lose pips. Everyone likes losing trades, but you're going to be in and out as quick as possible because you're going to see the change. You're going to know it's going against your position and you know exactly when to get out. Whereas other times, if you know you've got a really strong trade and the market's just having a little bit of intraday noise against you, you're going to have the confidence to hold that position a little bit longer, maybe use a slightly bigger stop so you can let the price do its thing. And then ultimately, the price will move in your favor and you'll end up making some pips. So all in all, that's what you need to do. That's the second reason why so many retail traders get whipped out. Again, it's not the broker moving the price against you. It's definitely the market. And sometimes it can seem random. And the more random it seems is basically correlated to the least or the less you know about what's happening. So if you don't look at the feeds at all, the market's going to seem completely, totally random. If you're watching the feeds every minute of the day and you've always got a screen dedicated to them, then the market's going to appear much less and less random. It will still have its random times, but you're going to reduce that significantly. And the reduction is going to be enough for you to be able to sustain and make a consistent profit over time. That's the key. So that's the concept of